Hey guys, RexFinance here, the one you've been missing, or maybe you haven't been, I don't know, but I'm on my way to the recording studio now, so stick tight. But I want to clarify some things before I get into this video. By the way, it is glow hour outside if you can't tell. Whew, looking good in the sun, and I also have my co-pilot riding with me. I hope you can see him, my rubber ducky's my co-pilot if you can't tell. But I want to clarify this video. The video title is going to be something like, the stock market has bottomed already and nobody noticed, or something like that. And I want to clarify to you guys, I by no means think that this stock market is just going to go straight back up to the moon. I don't think that is feasible at all. We have a lot of issues in the economy, a lot, and they're not going anywhere anytime soon. I mean, today after hours, AMD, wow, this is bumpy. AMD after hours slashed their guidance for the quarter by $1 billion. You're going to continue to see things like that happen. The economy is not going to fix itself overnight, but in today's video, I'm simply entertaining the idea that maybe the market bottom is behind us and none of us noticed. I'll be diving into everything that makes me believe that. Just give the video a chance. If you're new here, returning and not yet subscribed, please hit that subscribe button. I always love seeing all the new faces, and I'm not quite to the recording studio yet. Wow, I said yet twice, but I will be in about a minute. But to burn the time, my 3-year date anniversary, oh wow, glow hour, woo, anniversary, but dating, whatever you call that, 3 years with Bailey. So I want everybody in the comment section to give a shout out to Bailey, tell her thank you for putting up with RexFinance. It's not easy. It's not easy to do that. But yeah. And just a side note, I have to water a plant called a mum. Let me show you. Okay, I wanted to make sure nobody else was out here, otherwise this would be really awkward. But apparently, this is what you call a mum, and it looks like ugly right now, but if you give it some water, which, oh boy, that's going everywhere. I don't know how much to give it, but if you give it some water, a little bit of a catalyst, it turns into something beautiful. And I'll put up a picture on the screen somewhere. Okay. But a mum is a lot like the stock market during a bear market. Okay, that might have been a really bad analogy, but I thought it was clever. Just humor me and hit the like button for me. But the stock market right now and during any bear market is ugly. And right now is no exception. I mean, the NASDAQ from highs is down 27%. And anytime we've gotten a little bit of momentum, it just gets shot right back down. It's been brutal to be an investor in this market. But one thing that is certain about the stock market is that it usually ends up bottoming when nobody expects it. If we go back to the COVID lows, did anybody expect the markets to bottom in mid-March and early April? Not really. 2008, 2009, did anybody expect the markets to bottom in December of 2008 and January through March of 2009? Not really. Lots of things looked grim during both those time periods, but that is when the market bottomed. And I believe, as I already covered when I started this video, that this bottom we hit on September 30th is going to end up being the long-term stock market bottom, contingent on one thing. We've already rallied about 4.7% from the lows, and in my most recent video, I said that I expected a 10 to 15% rally in the NASDAQ before the next CPI read, and somebody commented that they would be willing to eat their hat if that happened, so secretly I am rooting for the markets to rally by more than 10% just to hold that guy accountable. But I mean, other than this most recent 4.7% rally, it's just been like ripping Benjamins in half. Like, totally copy money, totally fake, don't worry, but it says copy money. But that's what it's been. And I want to give you guys some hope in the stock market as to why we might have already bottomed. Right now, obviously, the market's main concern is bringing inflation down, and then a close second is what the Fed is going to do, because the Fed has screwed up big time in the past, like we all have, let's be honest, and they will screw up again in the future. That's inevitable. But what's really important is, as I already mentioned again, we have CPI data coming out on Thursday, October 13th at 8:30 a.m. Eastern Time, 7:30 a.m. my time, and 5:30 a.m. Pacific. That's why you go to college. I think I got that right. But we can look and see, thanks to this clevelandfed.org, what the anticipation, what the estimation is for this CPI read. And for September, they expect CPI to come in at an increase of 0.32% month over month, and year over year for it to come in at 8.2%. Now, one big mistake I think the markets in general are making is forgetting that inflation has been squashed. These month-over-month readings have been flat. In July, we had 0% increase month-over-month in inflation. In August, we had 0.1% month-over-month inflation. Annualized, that's only a 1.2% inflation rate. So inflation has been squashed. Inflation is in the rear-view mirror. Now, yes, we're expecting a 0.32% read this month, which annualizes to about 4%. Annually, obviously that's what annualized means, but still, we are miles ahead of where we used to be, where we used to get 0.9% inflation month over month, 0.7, 0.6, 0.8, 1.2, which annualized is like 14% inflation. We have come down significantly since then, and this is the big mistake the markets are making. They're going to look at this read, and they're going to take this year-over-year percentage change of 8.2% and say, we still have a lot of work to do. Inflation's 8.2%, but we need to remember the month-over-month readings are far more important to tell us what impact the Fed decisions have made thus far. All of the inflation data we get is lagging. All of the economic policy changes that the Fed makes are lagging. It takes time to hit the economy. It takes time to start to bring prices back down. And that is why it is so important to look at the month-over-month readings. We don't want inflation to run back away from us by any means, but we also don't want to over-tighten the economy, and there's a very good chance the Fed might do that, and that is going to be painful if it happens. But I'm going to trust the Fed here. I know, famous last words, but I am going to trust the Fed in my thinking that they know how to do their job, and they know what indicators to look at. They shouldn't be looking at these year-over-year comparisons, because what the CPI data showed a year ago in relation to the most recent CPI data is far out of our control. Prices have risen significantly year over year. But if month over month inflation is stifled, that is all that should matter for the Fed. So I think if we get another flattish read here with CPI data, this rally we've started to see in the stock market is going to continue, and we're going to put in this long-term bottom. As the Fed, if you take care of the month-over-month comparisons, the year-over-year comparisons are going to take care of themselves over time. That is not something you can change overnight. It's simply impossible with how much prices have risen across our economy. If we get somewhat of a flattish read, I think the Fed is going to take a step back maybe and just wait it out. Let's see how all of our policy action has impacted the economy. Let's wait a month or two and really see how the jobs market reacts, how prices react to these hikes in interest rates we've already done, because again, it takes time before the economy starts to see the impact of those. But again, I want to reiterate, the Fed has made mistakes in the past, huge mistakes, and they're going to make huge mistakes again in the future, and that's something we have to consider as investors. Particularly what I'm talking about is shown by this commodities index here at tradingeconomics.com, shout out. But basically, commodities bottomed in April of 2020, shortly after the stock market bottomed. And ever since then, up until recently, commodities have just been soaring higher and higher and higher. And throughout all of that, the Fed was still stimulating the economy. How stupid. I know. Retrospect, hindsight, always easy to judge. But I do not understand how the Fed has forgotten that commodity prices are perhaps the best, if not the only leading indicator on inflation that we have, because commodities are the input prices for all manufacturers, whether that's corn, soybeans, lithium, any sort of metals, you name it, every single commodity, lumber, all of those are input prices for manufacturers, and if those are going to go up, they're going to raise prices on their goods and services, which leads to inflation. And throughout all of this, the Fed was still stimulating the economy and printing the money printer, or running the money printer. So I guess what my optimistic hope is this time around is that the Fed has learned from this experience. Now that the commodities are cooling off, they've come down significantly since June of this year, that they're going to take a step back. Input prices are coming down. Let's hope they continue to do so, but let's take a step back. But the bottom line is for September's CPI data, which is going to be coming out on October 13th, year over year, you're comparing this little time period here on the chart to this time period on the chart. What do you think year over year inflation is going to show? Commodity prices are still much higher than they were a year ago. Inflation year over year is going to come in high. But month over month, September compared to August, commodity prices came down quite a bit month over month. But until commodity prices come down far enough, say this index gets to 3,000 by the end of October, we're going to have terrible year over year comparisons for inflation. This is just simply how it works. But if this index comes down to 3,000 over the next month, all of a sudden you're comparing a 3,000 right here to a 3,000 in October right here. Oh, that's not too bad. Inflation year over year is not too bad. And when that happens, all hell is going to break loose in the stock market. The peak in this commodities index was around 4,300. We're already down to 3,600, but we would need to go down another 619 points here. So there's still a lot of work that needs to be done. There's still a lot of prices that need to come down for commodities. All of this jargon happening overseas, the bombing of the Nord Stream pipeline, you name it. Things like that are still going to happen. I mean, Russia and Ukraine are at war. Things like that are going to continue to happen. But if commodities overall continue to fall, inflation numbers are going to start looking better and better and better. And this is where the Fed needs to be very, very careful right now. Don't over-tighten. We've already seen with commodity prices that you're doing the right thing. The choices you've made have already started to show a positive impact on the economy through declining input prices. Let's take a step back here, and I think the Fed is going to be smart enough to do this. We also have this headline. Yes, I know it's a headline, but it's a fact. The stock market has risen after every midterm election since 1950. 72 years of history, and the stock market has always risen after every midterm election. And you want to know what else also holds true? That in 95% of midterm election cycles, the stock market ends up finding a bottom in the first week of October and then rallying up until that midterm election. Politics play such a big part in the stock market. For better or worse, you cannot look past it. So call me an optimist, but I think a single positive catalyst for the stock market, just like the water was for the mum outside, is going to be enough to propel this stock market higher and set a long-term bottom here. We have history on our side. Valuations are at historical lows, no matter what valuation metric you use. You have a midterm election year. You have the fact that inflation has been stifled. There is a lot of positivity amidst all of this negativity that people are just choosing to ignore right now. And typically, that's when you find a stock market bottom, when nobody is expecting it. Now, I do have to say, I am biased against this happening. I do not want the stock market to go up from here because I graduate in December. Thank the Lord. I'm so ready to start making money instead of spending money on a degree that has, don't tell the university, has been kind of useless to me. But I don't want the stock market to go up. I am biased against everything I've said in this video. I'm just telling you like I see it. I don't know if that made sense, but I don't know what the saying is, but I am being honest with you about what I'm seeing, and I'm breaking this down for you. I think a long-term stock market bottom, if CPI data comes in flattish, is very likely. But yeah, I want to enter my career with the best buying opportunity of my lifetime. That's what the investor in me wants. I want to be able to buy significantly lower prices than we're even experiencing now. But unfortunately, I do not think that's going to happen. But anyways, in addition to giving a shout out to Bailey in the comment section below, let me know what you think is going to happen. Do you think I'm crazy? Do you agree with me? Comment down below, whatever it is, whatever your opinion is. I'll reply to everybody that comments. Also, please hit that like button for me. And don't forget to subscribe if you're new here, returning not yet subscribed. With that, keep your chin up, 10 toes to the ground, stay blessed, and peace out.